Imagine looking at your company's balance sheet and realizing you have $500 million of your own cash just completely missing.
Right, just totally unaccounted for in your daily liquidity.
Yeah, just gone from your day-to-day view. Welcome to the deep dive. Today, we're opening up a stack of sources that explore this massive structural blind spot hiding inside the global financial system.
And we are not talking about a rounding error here or, some obscure accounting trick.
No, definitely not. We are talking about hundreds of millions of dollars in working capital. And for you listening, the most fascinating part is where this money is hiding. It's in corporate tax compliance.
It really is a remarkable situation.
Yeah.
Because, when most people hear the phrase tax compliance, their minds immediately go to legal obligations.
Oh, absolutely. Audits, right.
Right, you think of audits, government filings, you assume any money tied up in tax is just money the government has already seized. But that is fundamentally incorrect.
Yeah, it's so wild to me.
The cash we are talking about today isn't being withheld by tax authorities. Multinational corporations are essentially hiding this money from themselves.
Let's lay out the specific numbers from our research just to ground this for you. According to the sources, if you look at a typical global enterprise, specifically one operating across 15 or more value-added tax, or VAT, jurisdictions, there is between $50 million and $500 million sitting completely out of sight.
Which is staggering.
It is. That is their own money, legally owed to them. So the immediate question is, how does an organization with thousands of employees and, highly sophisticated accounting systems simply lose sight of $500 million?
Well, to understand that, we really have to look at the internal architecture of a modern corporation. Our sources point directly to this profound disconnect between two departments that often sit on the exact same floor of a corporate headquarters.
Treasury and tax.
Exactly. Treasury and tax. They might share a building, but operationally, they exist in entirely different universes.
The research breaks down their daily realities, and the contrast is just stark. I mean, you have the Treasury Department, and their entire mandate is forward-looking.
Right, they manage liquidity.
Yeah, they need to know exactly how much cash is available today to fund operations, or how much they might need to borrow to cover a shortfall. Their timeline is measured in days, if not hours.
But then on the other side of the floor, you have the tax department. Their mandate is entirely different. They are focused on statutory obligations, mitigating audit risk, filing periodic reports with various governments.
So they're always looking backward.
Precisely. Their timeline is inherently backward-looking. They are generally concerned with what happened last month, last quarter, or last year. So these two departments have different goals. They utilize totally different enterprise software systems, and they operate on completely misaligned schedules.
And sitting right in the middle of that gap between Treasury and tax is something called a VAT receivable.
Yes, the classic VAT receivable.
Right. And for anyone listening who doesn't live in the weeds of corporate accounting, a VAT receivable is essentially the tax a company has already paid on its inputs.
Like a purchase.
Exactly. Say a company buys 10,000 laptops across Europe for its workforce. They pay a significant value-added tax on that purchase. But because they're a business, they are legally entitled to get that specific tax money back from the government.
It's not a deduction on their income. It is a direct refund. It's literal cash.
Right. And that cash gets stuck in what the articles refer to as reclaim limbo.
Because the tax department operates on a backward-looking periodic schedule. They cannot simply ask for that refund the moment those laptops are purchased.
They have to wait.
They do. Under traditional compliance models, they have to wait for the end of the reporting period. So let's say it's a quarterly filing.
Okay.
The tax team has to manually extract the purchase data from various localized systems, verify all the vendor details, ensure the invoices are formatted to meet the specific requirements of the European country in question, assemble the claim, and finally submit it.
Okay, let's unpack this. This feels a lot like paying full price for a major home appliance, right? Knowing you have a massive mail-in rebate.
Oh, that's a great way to think about it.
Like you buy a $1,000 refrigerator and you are entitled to a $200 rebate. It is your money. But the system is designed in a way that forces you to wait until the end of the year just to mail in the paperwork.
Yep.
Then you have to wait for the manufacturer to process it, cut a check, and mail it back. You're just sitting there for months without your $200.
That is a very accurate analogy. What's fascinating here is when you scale that up to a corporation processing millions of transactions globally, it becomes a huge problem.
I can imagine.
During that massive delay, which can stretch for months, By the way, the company is effectively funding the tax authorities' float using its own working capital.
Hmm.
The government is holding on to $50 to $500 million of corporate cash, completely interest-free.
Meanwhile, the Treasury Department is flying blind. I mean, they might know, theoretically, that a VAT refund is coming at some point in the future.
Sure, theoretically.
But because the data is trapped in the tax department's localized systems, Treasury doesn't know the exact dollar amount. They don't know which specific jurisdiction the cash sits in, and they certainly don't know the date it's going to hit the corporate bank account.
Which means that cash is useless for day-to-day liquidity planning. I mean, a treasurer cannot use a theoretical, unfiled tax rebate to fund payroll next week.
Right.
Consequently, to ensure the business keeps running smoothly, the Treasury often have to go out into the market and borrow money, or they have to hold unnecessarily large cash buffers.
Both of which carry significant financial costs.
Huge costs. And all of this friction is generated by the time delay built into a periodic, backward-looking filing system.
So if the root cause of this trapped cash is the timeline, the weeks or months spent waiting for a quarterly deadline to manually assemble data, the logical solution is to remove the clock from the equation entirely.
Exactly.
And our sources outline a shift toward a concept called continuous transaction controls, which is essentially a real-time compliance model.
Yes. In a real-time compliance architecture, transaction data flows continuously. The moment an invoice is generated or received, the data is validated at the point of creation.
Meaning it's checked right then and there.
Right. It is machine-readable and structurally sound. Instead of waiting for the end of the quarter, the data is instantly aligned with local tax regulations.
Okay, I understand how that accelerates a refund. If the data is constantly validated and flowing, the tax team can file for reclaims proactively, and Treasury gets visibility into their cash position instantly.
Rather than waiting for a quarterly report, yes.
But here's where it gets really interesting, but I need you to explain this. The sources state that implementing this real-time tax compliance technology actually lowers a company's DSO, days sales outstanding.
Yeah, yes.
So DSO measures how long it takes a customer to pay an invoice. I can see how filing a form faster gets a government refund faster, but how does tax compliance software physically force a third-party customer to pay their invoice faster?
It is a non-obvious connection, I agree, until you break down the mechanics of a rejected invoice. When an organization looks at why their DSO is degrading, why it takes 60 or 90 days to collect cash from a customer instead of 30, they usually find that the delay is rooted in disputes.
Okay, disputes, like over a wrong product or something.
Right. We tend to think disputes happen because a customer claims they received the wrong product or the pricing was incorrect. And while those commercial disputes do happen, a surprising percentage of rejected invoices are actually driven by compliance errors.
Meaning the structure of the invoice itself is legally flawed.
Precisely. Let's trace the journey of an invoice that contains a compliance error. Suppose a company issues an invoice to a customer in Italy.
Okay, Italy.
But the invoice carries an incorrect tax classification code, or it's missing a specific vendor registration number that's required by the Italian tax authority's e-invoicing platform.
So what happens?
The invoice is transmitted to the customer's accounts payable department. The customer's automated system scans the invoice, flags the missing data, and recognizes that if they pay this non-compliant invoice, they will not be able to claim their own VAT deduction later. So what do?
They reject it to protect their own compliance position.
They reject it. The invoice gets kicked back. It enters a dispute queue. Now, a human being in the accounts receivable department has to manually review the rejection, figure out what went wrong, contact the customer, correct the tax classification, issue a credit note for the bad invoice, and then finally generate a new compliant invoice.
Wow. And that takes time.
That entire dispute cycle can take 3 or 4 weeks to resolve. And here is the critical part. The 30-day payment clock hasn't even started ticking yet. The customer isn't going to pay until they have a legally valid document.
Oh, I see the mechanical link now.
Yeah.
The delay isn't because the customer is refusing to pay. It's because the seller gave them a document they legally cannot process. So how do continuous transaction controls alter that timeline?
Well, with real-time compliance infrastructure, the validation happens before the invoice ever leaves the seller's system.
Oh, before it even sends.
Exactly. As the invoice is generated, the software checks the tax classifications, verifies the partner data against local registries, and ensures every single field matches the incredibly complex, localized regulatory format required by that specific country.
Right.
So by the time that invoice actually arrives in the customer's inbox, It is already tax authority cleared. It is structurally perfect and legally valid.
It is fundamentally dispute resistant.
Dispute resistant is the exact phrase. When you deploy this technology across millions of high-frequency transactions, your compliance-related error rate drops to near zero.
That's huge.
You eliminate those 3-week manual dispute cycles entirely. The customer receives a perfect invoice on day one, and their accounts payable system can process it for payment immediately. That is how compliance technology directly causes a massive, measurable drop in days sales outstanding.
Let's take that a step further, because the sources point out that an invoice that is mathematically and legally impossible to dispute is no longer just a standard bill.
No, it becomes something else entirely.
Right. It transforms into a highly trusted financial instrument. And that realization opens up a completely different layer of this deep dive, which is the global supply chain finance ecosystem.
Yeah, because optimizing working capital rarely stops at your own internal receivables. Large enterprises routinely engage with external financial markets.
Through mechanisms like early payment programs, dynamic discounting, or supplier financing.
Yes, and the foundation of every single one of those financial instruments is trust. A bank or a financing partner evaluates the risk of a transaction before injecting capital.
To put this into perspective, think about a traditional invoice in a legacy system. It is essentially an unverified personal check.
Oh, good analogy.
Like if I hand you a personal check for $10,000, it might be perfectly good. I might have the funds in my account. But as the recipient, you carry inherent risk.
Because I don't actually know if the check will bounce.
Exactly. Or if my signature is wrong, until the bank processes it days later. If I try to sell that personal check to a third party for cash today, they are going to charge me a hefty fee to take on that risk.
And compare that to an invoice that has been validated through a continuous transaction control system.
Right. A real-time, tax authority-cleared invoice is like handing you a certified cashier's check.
Yeah.
The bank has already verified the funds, the identity is confirmed, and the legal standing of the document is absolute. Everyone in the financial ecosystem trusts a cashier's check instantly.
If we connect this to the bigger picture, that analogy captures the economic shift perfectly. Supply chain finance partners, whether they are global banks or specialized factoring firms, are deeply concerned with validation costs and dispute risks. When a company presents an invoice that carries that cashier's check level of legal certainty, the credit risk associated with potential disputes is effectively eliminated. The compliance architecture has already performed the risk mitigation that a bank would normally have to do manually.
And because that risk is removed from the equation, the cost of financing drops. Suddenly, the company unlocks access to cheaper credit, or they can offer more aggressive dynamic discounting to their own suppliers because the underlying transactional data is just bulletproof.
It creates a ripple effect of liquidity across the entire supply chain.
Okay, so we've established that this technology unlocks hundreds of millions of dollars in trapped VAT. It structurally repairs days sales outstanding by preventing customer disputes, and it drives down the cost of capital in supply chain financing.
All of which is incredibly valuable.
So if the financial incentives are this overwhelming, the obvious question is, why isn't every single chief financial officer on the planet already mandating this transition?
Well, the barrier is not a lack of desire. It is a structural trap created by how multinational corporations have historically purchased software.
Okay.
The sources refer to this as the patchwork trap.
Patchwork trap. Got it.
If you look at the growth trajectory of a global enterprise, they rarely build a global compliance system from scratch. They expand regionally, they enter Germany, and the local tax authorities have specific digital reporting mandates, so the company purchases a specialized compliance tool just for the German market.
Makes sense.
A year later, they expanded to France, and they procure a completely different vendor's software for the French market. Then they enter Brazil, which has notoriously complex, localized tax codes, and they buy a dedicated Brazilian system.
So over a decade of expansion, they accidentally build a Frankenstein's monster of decentralized software.
That is the patchwork trap. Now, from a strictly legal perspective, this patchwork actually works.
It does.
Yeah, the local tax teams in Germany, France, and Brazil are successfully filing their returns. The company has compliance coverage. They are not breaking the law.
But they have completely isolated their data.
Yes, because the transactional data is sitting in 5 different local systems, utilizing 5 totally different data models and formatting standards. Those systems cannot communicate with each other, nor can they communicate effectively with the central corporate ERP.
If this fragmented, localized software is the root of the visibility problem, the logical solution seems to be, ripping all those local tools out and replacing them with one massive, unified, global tax system.
You would think so.
But from an IT integration perspective, replacing legacy software in 20 different countries sounds like a decade-long implementation nightmare that most CFOs would actively avoid.
Ripping and replacing core systems is incredibly disruptive, which is why the sources point toward a more elegant solution: centralized data orchestration.
Okay, how does that work?
The goal of an orchestration architecture isn't to necessarily rip out the localized tools that are already working. Instead, you deploy a unified data layer that sits above the fragmented systems. Think of it as a universal translator.
So it acts as a bridge between the local compliance tools and the central treasury department.
Exactly. The orchestration layer continuously ingests the diverse, localized data streams, the Brazilian format, the German format, the French format, and standardizes all of it into a single unified data model.
Wow, that's smart.
It translates the localized compliance data into a universal language of financial intelligence. Crucially, it then feeds that standardized real-time data directly into the downstream systems used by Treasury, finance, and supply chain planning.
Which means everyone in the corporate headquarters is finally looking at the exact same truth simultaneously. There's a specific quote from the research that summarizes the strategic advantage of this approach perfectly. Let me just read it.
Yeah, go ahead.
The organizations pulling ahead are not the ones who have the most compliance tools. They are the ones who have a single, centralized view of every transaction in every jurisdiction in real time.
And that centralized view is what enables a massive operational shift. It moves the Treasury Department from a model of prediction into a model of precision.
Let's expand on that difference, because predictive sounds like a positive term in business, right? But the sources frame it as a severe limitation.
When a Treasury Department is trapped in a predictive model, they are managing corporate liquidity based on historical estimates. A treasurer might say, historically, in the third quarter, our German operations generate this much VAT reclaim, and it usually takes 60 days to process.
Right, based on past trends.
Therefore, let's forecast our Q3 cash position based on those assumptions. But assumptions are inherently risky. When you are managing billions of dollars of working capital based on estimates, you are forced to hold massive cash reserves to protect the business against the margin of error in your own forecast.
You're holding dead capital just in case your historical guess is wrong.
Precisely. But when you introduce centralized data orchestration, you transition to precision. The cash position is no longer an estimate. It is an absolute known quantity.
Because it's based on real-time data.
Right. The treasurer can open a dashboard and see, down to the cent, exactly how much VAT is owed across 20 jurisdictions, fully validated and dispute-free. The funding needs of the business become continuously visible.
They don't need those massive buffers anymore.
No, they can lower their cash reserves, reduce their borrowing, and deploy that capital into growth initiatives.
For you listening to this deep dive, whether you are a financial executive trying to squeeze more liquidity out of your operations, a technology strategist interested in data architecture, or just someone who is fascinated by hidden inefficiencies, the core takeaway here is profound.
It really is a paradigm shift.
The companies that are positioning themselves to win in this new regulatory environment are no longer looking at compliance as a burden. They aren't asking their teams, how do we meet the bare minimum legal requirements in this new country?
Right.
They are asking a much more strategic question. How do we design an operational architecture where every single transaction we process globally generates instant actionable intelligence for the rest of the business?
Compliance is no longer the final objective. Compliance is simply the mechanism by which a company extracts financial intelligence. And this evolution raises a final, highly provocative thought for you to mull over.
What's that?
We have spent this entire discussion focusing on how this real-time infrastructure allows a corporation to finally see its own financial data clearly. But we must remember the catalyst for this entire shift: the global tax authorities.
Right.
The governments are the ones mandating these continuous transaction controls in the first place.
They are building the digital infrastructure to ingest this transactional data instantly.
They are. Tax authorities worldwide are successfully constructing centralized architectures capable of seeing every single corporate transaction in real time. So if a corporation refuses to adapt, If they cling to their fragmented patchwork of local reporting tools and continue to manage their business using spreadsheets and end-of-month estimates, they are setting themselves up for a severe informational disadvantage.
That's a scary thought for a business.
It is. I mean, how long will it be until a localized government tax authority actually has a clearer, more accurate, and more timely picture of a company's global supply chain health than the company's own chief executive officer does?
Wow, that is an incredibly motivating reality check. The idea that a regulatory body could understand your real-time cash position and supply chain velocity
Perfect.
before your own executive team can even assemble the quarterly report.
Something to think about, definitely.
We have covered immense ground today. We unpacked the internal silos separating treasury and tax, explored how the real-time data revolution mathematically eliminates dispute cycles to fix days sales outstanding, and outlined how centralized orchestration transforms a compliance burden into a $500 million strategic advantage. So take a look at your own organization systems and ask yourself where your working capital might be trapped in reclaim limbo. Thank you for joining us, for bringing your curiosity, and for diving deep with us today. We will catch you next time.